You already know that Florida does not tax your pension. Everybody knows that. It's the first thing anybody says at a retirement party. But here is what almost nobody knows, and I want to put it in the first 30 seconds because it changed how I look at this whole subject. There is a state in this country that does charge an income tax, a plain, ordinary state income tax that working people pay every year, and that same state charges a retired person exactly $0 on their Social Security, 0 on their pension, 0 on their 401k withdrawals, and 0 on their IRA distributions. No cap, no phase out, no income limit. And most retirees have never once considered moving there because it isn't on any of the lists, because the lists only look at one number. Today, I'm going to walk you through the 3 states that take the biggest bite out of a retirement check in this country, and the 5 states that leave the most in your pocket. And I'm going to show you why the headline everybody repeats is the least useful number of the 4 that actually matter. My name is Harold Briggs. I spent 43 years inside the same small-town bank in Ohio, teller to branch manager, and I want to tell you why I have opinions about this, because it isn't from a brochure. Over 4 decades, I watched a great many of my customers retire and move away. Arizona, Florida, the Carolinas, Tennessee. We'd close out accounts, wire balances, wish them well. And here is the part almost nobody talks about. A certain number of them came back. Not all of them, not even most, but enough that I started keeping track in my head. And because I was their banker on both ends, I saw something the brochures never show you. I saw the account before the move, and I saw the account after. I saw what actually happened to the balance, not what the sales pitch promised. And what I learned in those 2 decades of watching people leave and come home is the whole reason for today's video. So let's use it. Here's the plan. 3 worst states, 5 best states, counting down, and along the way, the 4 separate ways a state reaches into a retirement check, because most people only ever check one of them. And I'll tell you now, number 3 on the good list is the one that genuinely surprised me, because it's a state most people scroll right past, a state with an income tax on the books that ends up charging a typical retired household less than Florida does once you count everything. I'm not going to make you wait until the end for it. And if you're sitting there thinking none of this matters because you're never moving anywhere, stay with me anyway, because the second half of this video is going to change how you look at the state you already live in. Now, the 2 thoughts I can hear forming. Thought 1, Harold, I'm not moving. I've been in this house 40 years, and they'll carry me out of it. Friend, good, and I mean that. But this video is not really about moving. It's about knowing. Because once you know how your own state treats a pension, a 401k withdrawal, and a Social Security check, you can do 3 things you cannot do while you're ignorant of it. You can time your withdrawals better. You can find out whether your state has a retirement income exclusion you've never claimed, and a great many do, sitting in a form nobody handed you, and you can stop guessing about the thing that quietly sets the size of your paycheck every single year. Thought 2, the opposite one. Harold, I already know the answer. Everybody knows the answer. It's Florida. No income tax. End of discussion. Well, hold on. Because there's a whole category of cost the no income tax headline doesn't cover, and I've watched it eat the savings entirely in real accounts belonging to real people I knew for 30 years. That's the part I most want you to hear today. And here is the one idea that makes everything else make sense, so hold on to it. The state does not tax you once. It taxes you 4 ways. Number 1, income tax, on your pension, your withdrawals, and sometimes your Social Security. Number 2, property tax on the house you live in. Number 3, sales tax on nearly everything you buy for the rest of your life, including, in some states, your groceries. And number 4, and this is the sneaky one that has grown into a monster in the last few years, the cost of insuring the place you live, which is not a tax at all, but leaves your account every single month exactly like one. Now, every ranking you have ever read, every article your brother-in-law forwarded you, looks at number 1 and stops. And a state that gives up number 1 has to make up the money somewhere, friends. They are not running a charity. They will get it from 2, 3, or 4. So the only honest way to compare 2 states is to add up all 4. That's what we're doing today. So let's start with the damage. The 3 worst states in America to retire on a pension, as things stand as I record this. And number 3 on that unhappy list is going to surprise a lot of you. Vermont, beautiful state. Some of the prettiest country in America, and one of the hardest places in the nation to live on retirement income. Vermont begins taxing your Social Security benefits at one of the lowest income thresholds in the entire country. We're talking around $50,000 of income for a single filer, which is not a wealthy retiree. That's a school teacher with a pension. Your pension income gets taxed at rates that climb up toward 9%. Your 401k withdrawals right along with it. And then there's an estate tax waiting after you're gone. A retired couple pulling $50,000 from a pension with $25,000 in Social Security is looking at something in the neighborhood of $3,000 to $4,000 a year in state income tax alone, in a state that also carries some of the steepest property taxes in the Northeast. That is real money walking out the door every single year for the privilege of the view. Number 2 on the worst list, Minnesota. And I know exactly what some of you are thinking, because I thought it too. Minnesota has the Mayo Clinic. Minnesota has extraordinary hospitals, and that is genuinely true and genuinely worth something. But none of it changes what the state does to your budget. Minnesota taxes your pension, your 401k, and your IRA withdrawals at ordinary income rates, and it still taxes Social Security for households above roughly $80-some thousand, and it carries an estate tax on top. So you're paying while you're here, and your children pay after you're gone. A retiree with a $65,000 pension and $25,000 in Social Security can be handing the state somewhere around $4,500 a year. Say that as a monthly number instead, because that's how retirement actually feels. That's roughly $375 a month, gone, before you've bought a single bag of groceries. And number 1 on the worst list, and this one surprises nobody, California, the highest top income tax rate in America. Now, in fairness, and I always want to be fair, California does fully exempt your Social Security, which is real and which matters, but it taxes every other dollar of retirement income you have. The pension, the 401k, the IRA, annuity income, all of it, with no retirement exclusion to speak of. A retiree with $60,000 in pension and $30,000 coming out of an IRA can be handing California in the neighborhood of $5,000 a year in state income tax. And that is before you say one word about what a house costs there, or about what has happened to homeowners insurance in wildfire country in the last 5 years, which is its own separate catastrophe. All right, so the obvious conclusion, the one everybody jumps to, is pack up and move to a state with no income tax at all. Florida, Tennessee, Nevada, Texas, and be done with it. And that is often right. But before we count down the good list, hear the warning, because this is the part I watched happen at my own counter. A state with no income tax still needs revenue, and it gets it somewhere. Property taxes, sales taxes, including, in some places, tax on your groceries, insurance costs driven sky high by hurricanes and wildfires, homeowners association fees that climb every single year and answer to nobody. Watched customers of mine save $3,000 a year in income tax and then spend $5,000 and $6,000 more on insurance and fees than they had ever paid in Ohio, and wonder why the account was going down faster than before. They didn't do anything foolish. They read the headline, and the headline was one number out of 4. If that idea alone was worth your 20 minutes, hit the like button, because it pushes this video in front of the next couple who are about to make a $50,000 decision off a magazine article. And subscribe. I make one of these every single day. All right, the good list, counting down from 5. Number 5, Iowa, the Midwest sleeper, and hardly anybody has noticed. Iowa overhauled its entire tax code recently, and here is where it landed. Starting at age 55, retirement income is exempt from state income tax. Social Security, pensions, 401k, IRA, all of it, 0. And they got rid of their inheritance tax as well, so what you leave to your children passes at the state level without a bite taken out. Now, I won't pretend Iowa is for everybody, and the weaknesses are real. Winners that mean it. Fewer big city amenities once you're outside Des Moines. Property taxes around 1%, which is not cheap. And specialist healthcare gets thin outside the metros, which matters more every year you age. But on the pure arithmetic of protecting retirement income, Iowa is quietly doing something most people have not caught up to yet. Number 4, Nevada. Simple and clean. No state income tax. No estate tax. No inheritance tax. And property taxes that run among the lowest in the country. We're talking under 0.5% in many places, which means a retiree in a $400,000 home outside Las Vegas can be paying something like $1,800 a year in property tax. $1,800. There are counties in Pennsylvania and New Jersey where people pay 4 times that, So why isn't Nevada number one? Healthcare access. Nevada ranks well down the national list for doctors per resident. And I want you to think hard about that one, because at 65, it feels like a footnote, and at 80, it is the whole ball game. If you are healthy and independent, Nevada is a tremendous financial deal. If you're planning for a stretch where you or your spouse might need specialists regularly, the number of doctors in driving distance is not a lifestyle preference, friends. It's part of the arithmetic. And number 3, the one I promised you, Pennsylvania. Now I know what happens when I say that. Most people hear Pennsylvania and retirement in the same sentence, and they keep scrolling because Pennsylvania has an income tax. Everybody knows Pennsylvania has an income tax. Here's what they're missing. Pennsylvania exempts 100% of your Social Security from state income tax, 100% of your pension, public or private, 100% of your 401k withdrawals, 100% of your IRA distributions, no income cap, no phase-out, no means test. Their flat rate, which is a hair over 3%, applies to earned income, investment income, and capital gains, and that is all. So if you are a retired person living on Social Security, a pension, and withdrawals from your retirement accounts, which describes an enormous share of the people watching this, your Pennsylvania state income tax bill on that income is $0. Functionally identical to Florida, functionally identical to Tennessee, in a state nobody puts on the list. Now, I promised you honesty, so here is why Pennsylvania is at number 3 and not number 1. Property taxes, which in a lot of Pennsylvania counties run $6,000, $7,000, $8,000 a year on an ordinary retiree's house, driven mostly by school district taxes, and an inheritance tax that starts at the first dollar, 4.5% on what you leave your children, higher for siblings, which on a decent-sized estate is real money to your family. So it is not a free lunch. But look at what the trade actually is. You're trading a bigger property tax bill for a zero income tax bill on everything you live on, in a part of the country with a deep bench of major hospitals within driving distance. For a certain kind of retired household, and you'll know if it's yours, that math is not close. And nobody is telling them, because Pennsylvania doesn't make the lists. Number 2, Tennessee. No income tax at all, no estate tax, no inheritance tax, property taxes averaging well under 1%, strong hospitals in Nashville, and a cost of living that runs below the national average. Tennessee earns this spot honestly, but it has one weakness that almost nobody accounts for, and it's a beautiful example of what I told you at the start about the 4 ways. Tennessee has about the highest combined sales tax in America, pushing into the 9.5% range in many places, and it taxes groceries, food, every week for the rest of your life. A retired household spending $50,000 a year on taxable goods can be paying somewhere near $4,000 to $5,000 a year in sales tax. That is another $300–400 a month, and it will never appear in a single article about tax-free states, because sales tax arrives in pieces, and pieces don't get counted. And number 1, Florida. And look, Florida earns it. I'm not here to be contrarian for sport. No state income tax, written right into the state constitution, so it isn't going anywhere. No estate tax, no inheritance tax, and something the other states genuinely cannot match, which is infrastructure built for old age. Senior communities, geriatric specialists, doctors who have seen 10,000 patients your age, airports everywhere so the grandchildren can actually come, plus a homestead exemption that caps how fast your assessed value can climb once you're in. On the full scorecard, Florida wins, and it deserves to. But I would not be doing my job if I stopped there. Homeowners insurance in Florida now averages in the neighborhood of $7,000 a year, the highest in the nation. And in coastal counties, you can be looking at $10,000 and up, with flood insurance stacked on top of that. So run the arithmetic honestly. A retiree who saves $3,000 a year in income tax and then pays $5,000 more for insurance did not save money by moving. He paid for the sunshine, and if the sunshine is worth it to him, wonderful. That's a fine reason to move. Just don't tell yourself it was a financial decision when it was a weather decision. Both are legitimate. Confusing them is what costs people. Now let me tell you about the ones who came back, because that's my own data, and I've never seen it in an article. Over the years, I watched a steady trickle of customers return to Ohio, and when I'd sit down with them to reopen their accounts, I'd ask, gently, what happened? And I want to be precise here, because it was almost never the money by itself. The money is what made it possible to be honest about the rest. One couple, I'll call them the Websters, sold up and moved to a beautiful place in Florida at 68, came back at 76, And Ruth Webster told me the arithmetic in about 4 sentences. The insurance went up every single year, faster than anything we'd budgeted. The property tax on the new place reset when we bought it, so we never got the benefit of the cap the neighbors had. And the grandchildren visited twice in 8 years, because it turns out a plane ticket for a family of 5 is its own kind of tax. And then she said the line I have never forgotten. Harold, we saved money on the state and spent it on the distance. I've thought about that sentence for 20 years. It's the truest thing anybody ever told me about retirement relocation, because the 4 ways a state reaches into your pocket are real, and you must count all 4. But there's a 5th column that never appears on anybody's chart, and it's the cost of being far away from the people who would drive over on a Tuesday if something happened. Put a number on that one before you sign anything, friends. For some people, it's small. For a lot of people, it's the whole decision. So here's your week, and it's a worksheet, not a phone call. Get a sheet of paper and make 4 columns. Column 1, what your state does to retirement income. Search your state's name plus the words retirement income tax exclusion. Or ask a preparer one question. Does my state tax pensions, 401k withdrawals, and Social Security? And is there an exclusion I should be claiming? Column 2, your property tax, the real number off your own bill, plus whatever senior exemption or freeze you might qualify for and have never filed. And if you haven't seen my video on that, it's worth your time. Column 3, sales tax, and specifically whether your state taxes groceries, because that one hits every week. Column 4, your homeowner's insurance. And here's the part that matters, not what it is today, what it was 5 years ago. The trend tells you more than the number. Do those 4 columns for where you live. Then, if you are seriously considering a move, do the exact same 4 columns for the state you're dreaming about and add a 5th line at the bottom, honestly, for what a year of plane tickets costs to see the people you love. Now you're comparing 2 retirements instead of 2 headlines. That's the whole exercise, and it costs you 1 afternoon and the price of a piece of paper. And do one thing for somebody else. You know somebody who is right now, this month, talking about selling the house and heading south because a friend told them there's no income tax down there. Send them this video today, before the house goes on the market, because this is a decision people make once, in their 60s, on the strength of one number, and then live inside for 30 years. Then leave me a comment, and this is the one I most want to read. Tell me what state you're in and what it actually does to your retirement income, good or bad, because the people in this comment section know things no ranking captures. And somebody scrolling past next month is going to make a better decision because you took 2 minutes. I read every single one. Subscribe, because next time I'm handling the part that comes after all of this, the money you leave behind. Some states take a bite out of what you pass to your children that starts at the very first dollar. No exemption, no threshold. And most families do not find out until the worst possible week. I'll show you what those states are and what can legally be done about it well in advance. Everything I've shared today is general educational information, not personal tax, legal or financial advice. State tax rules, thresholds, exemptions, and insurance costs change constantly and vary by county and by household. And every figure I've used is a rounded illustration as of the time I'm recording. Before you make any decision this size, confirm the current rules with your state's Department of Revenue and sit down with a qualified professional who can look at your whole picture. That's not me covering myself. That's just sound banking. Look after your money. You earned it twice. Once when you worked for it, and once when you kept it. If you want to protect the money you leave behind just as carefully, subscribe so you don't miss the next video. I'll see you in the next one.